Hi guys, today we will talk about what diversification is. If this is the first time you have heard about it, I believe it will be helpful for you to watch this video until the end. If you want to invest but are afraid of losing your savings, balancing your investment portfolio is the perfect solution for you. Diversification is when you spread risks across different assets to avoid significant losses. You should understand that diversification comes in various forms and every investor has their own goals. So, before you start diversifying your portfolio, you need to understand why you are doing it. One of the most common diversification strategies is to have 60% of your assets in stocks and 40% in bonds. Stocks are considered risky assets, so if you seek stability, you can create a sort of cocktail where half of your assets are high-risk stocks and the other half is reliable bonds. If you have diversified like this, in times when stocks are declining, the portion of your assets in bonds will provide stable dividends, supporting the overall performance of your portfolio during tough times. Conversely, when bond yields are dropping, stocks will likely be rising, balancing your portfolio and making it more resilient to crises and unforeseen circumstances. This was a simple example of diversification, and you don't have to follow the 60-40 strategy to reduce your risks. You can invest in other assets like gold, commodities, real estate, and more. As already mentioned, diversification aims to reduce the risks of your investments. But does it mean that when we diversify our assets, we lose the potential for higher returns? My short answer is yes and no. In a normal scenario, the more risk you take, the higher your potential returns. If you have information that a specific company will grow tenfold in 5 years, you don't need diversification. Because if you invest half your assets in lower yielding assets, you will miss out on potential profits. However, if you don't have such information, diversification can help reduce your risks, leading to lower returns but also lowering potential losses. Let's return to my previous question. Can you diversify without losing potential returns? My answer is yes, but you have to do it correctly. Let's imagine two companies, A and B, working in different sectors and with little correlation. After our analysis, we found that both companies have the potential to yield a 10% annual return. Do you think we will lose potential returns in this case? No. If we invest $1,000 in company which provide a 10% annual return, we will have $1,100. But what if we diversify our assets? If we invest $500 in company A and $500 in company B, both providing a 10% annual return, we will have $550 from each, totaling $1,100. At this point in the video, you have likely understood when your assets are better protected. It's correct in the case of diversification. If you invest all your money in a single asset and its price drops to zero, your investment becomes worthless. However, with diversification, even if the price of one company's stocks reaches zero, another profitable company in your diversified portfolio can offset the loss. For example, you would still have $550. Now, what happens when you diversify your portfolio to include hundreds of different stocks? You will reduce your risk by 100 times, but this assumes that you have chosen assets with similar profit potential. This approach allows you to minimize investment risks while still generating a profit. Even if a couple of companies out of 100 go bankrupt, your diversified portfolio will hardly be affected and will continue to bring you profits. Now you understand that diversification in investments is the same magic as the magic of compound interest, and if you know how to use these two instruments, the profitability of your portfolio will not make you wait long.